Hello all, my name is Jonas Thulin. I'm Head of Asset Management here at Erik Penser Bank, and I will try to very briefly and shortly give a quick roundup of how we view macro, especially in these turbulent times. Last couple of days brought us some headwinds on the equity market. We are standing firm. We do not believe the Federal Reserve nor the Riksbank will manage to hike to the degree that's been priced into the market. And we believe the market will fall back, so to speak, on the positive earnings and growth cycle that we're in, especially where we are positioned. Please do note that our biggest position for the time being is actually in Latin America, followed by North America in terms of IT, etc., and farms, US farms. But very, very briefly, we have a good stride. We keep on delivering or overachieving our competitors, and in global equities we have given up the great stride we did through our hedges during the outbreak of the war, but we are still sort of hitting the surf pretty good in terms of finding the right sort of momentum in the economy. If anything, we are increasing the number of bets right now, so we are creating a little bit more diversified portfolio than we had a couple of weeks ago, and there will be more details on that when we are done with the trades, which my colleagues are doing right now. For us, it's still important to understand, or we think it's important to understand, where the underlying business cycle is in terms of macro, and we are still constructively positive. We are keeping our overweights, we're keeping our exposure, as I said, LATAM, US tech, emerging markets, energy, renewable energy. A small position in Eurozone healthcare, that's the only Eurozone position we have. We have a US curve steepener, tilted towards a bull steepener. It's completely unhedged, so obviously we are also benefiting right now from the dollar exposure. And also we're still enjoying soft commodities. Apart from that, we are constructive on the equity market, and have been so from the 9th of March. We're keeping that position, and we do not sort of budge or become too nervous with the last few days move against us. We actually see this as building a great turnaround cycle, and I will show you that later on. But first and all, we have to go through the drive factors. Now I'm skipping US politics, which was the dominant factor in January. When we went into February, we saw that the traction between the equity market and geopolitical risk started to climb from virtually non-existing relationship to not perfect, but a very strong relationship right at the outbreak of the war. And then, as you can see, it's been a slippery slope ever since. Now, this is obviously in an asset management point of view. This is not the, so to speak, a human point of view in that sense. So that we have a very low correlation right now. It's something that we leave the human or social aspects out of it, and keeping a focus on asset management. As such, the relationship is non-existing and has to be dealt accordingly. We then traded inflation, which was a huge spike in interest, and right now we're not trading inflation any longer. We're trading a bit on Chinese port data, and I will come back to that, but not so much on inflation. We did utilize the inflation though to bring in positions in emerging markets, LATAM, energy, renewable energy, etc., etc. This was the previous inflation peak that we made a call, October, November. We think we got that fairly right. Then we had a very, very low and non-existing inflation all throughout January. And then obviously the war came with a second spike in inflation, and we believe that we've seen the peak again in CPI. Break-evens are confirming that. The last move is actually on the downside. We should go through to the equity market in a couple of days' time. We are also tracking credit card data in the US on US gas stations. As you can see on the right-hand side, we actually see a little bit of downside in terms of spending in gas stations, which hopefully should bring a lower inflation through the transportation side. But we've been utilizing this peak in the sense of doing a bull steepener, 2 stents in the US. Now, the market is a bit nervous now, given the fact that, will Beijing close down, what's happening in China, etc., etc. We have very few positions in Asia. We only actually have one in our sustainable portfolio in terms of Japan, and that's actually doing quite well. I'm just looking at port congestion here. We can actually see it falling, as we've been pointing out, ever since the peak in November, December of last year. But obviously the green here is increasing, which is Chinese data. This is Shanghai and Zhejiang, and obviously that is a bit of a concern if we see trickle-through effects to other ports. We do not see that today. Hence, the peak that we saw in October, November last year in terms of bottlenecks could probably manifest itself again. And with that, inflation will continue to roll over on top of arithmetic, and I'll come back to the wage cycle, etc., in the US. And that could be a quite interesting time for equities. Now, obviously, we keep on updating this view every single day. If we're wrong, we have to amend it. But for the time being, we sort of sticking to those calls. Now, why we stick into that is obviously that because the underlying pressure on inflation is virtually not here, and I will actually show you the wage data in a slide or two. On the top left-hand side, we actually look at what the corporates are telling us in terms of prices received and prices paid. That should be sort of a gross margin model for the economy. And we can put that, as you can see here, against inflation. There should have been a little bit of a traction here going on. There should have been a correlation, but obviously corporates overall, as they express their opinions in the beige book, etc., are not really feeling that they can transmit or transfer the PPI pressure into a CPI pressure. Hence, the CPI might be a little bit more hollow than we realize today. On the right-hand side, we are just looking at the demand-supply factors, because obviously, given the supply bottlenecks, that's sort of where we can sort of hit that. But that said, this would be great if we can see this peak. It is our case that we will peak, the inflation peaked in March. And if data changes, we will amend it. But so far, that's sort of where we're sticking our guns, and we sort of accentuated that by doing this bull steepener in the US. So how come that we are too nervous about wage growth in the US? And there are a number of reasons. Let me just show you a little bit of a tip of an iceberg here. We actually think the labor market is moving into a worsening state as we speak. Now worsening from very, very solid levels, so everything is relative. But on the upper right hand, you can also see that in terms of wage growth, there's actually one sector lifting the entire wage growth data in the US, while all the other sectors are talking for about a lower wage growth than we actually see. It's hospitality and leisure. Obviously, by rehiring after the pandemic, it's been a huge increase in the cost of that labor market. And it's sort of been affecting the overall national indices or national average. But so far, other underlying industries have not seen the same kind of wage trajectory. And if we collect all the important wage data, according to Bloomberg, and we put it against CPI, we can see that yes, we saw a spike, etc., but all of a sudden everything looks a bit hollow. And obviously, as we all understand it, as soon as we have the right base effects, this could be a quite self-fulfilling prophecy in the sense that we could deflate quite quickly. So we believe that the Federal Reserve is enjoying talking tough. They are being backtracking the 75 basis points quite rationally, but they will not be able to, they don't intend to deliver, and I will come back to that. And are we then unique in saying this? I think we are far from it. I think this is actually the consensus picture in terms of the bond market. This is why the break-evens been skyrocketing or moving in the 2-year, but not so much as you move further out the curve. Hence, the curve is collapsing in terms of break-evens. And you can plot that versus CPI, as I've done here, just for fun, just to see that it's kind of a huge difference we see between short-term inflation pressure and the longer-term inflation pressures. Now, in terms of Federal Reserve, it's been a quite interesting couple of days last week, especially towards the end, when you had a couple of speakers coming out saying, nah, this thing about 75 basis points is probably not going to happen. So you actually have a futures curve now that's going to hike, and then you're going to cut, and then you're going to hike, and then you're going to cut again. Obviously, this is all nonsense. It's not going to happen. But the market is doing a lot of the Fed's heavy lifting right now. The Fed will obviously make a shortcut and sort of dissect all the way through this by not intending to hike as much as previously believed. And we think that could be quite an interesting period for the equity market, especially when they start to signal this, which will come in due time if and when, which we believe will happen in the next couple of months, the inflation data is sort of giving them the argumentation for this. Now, there also another reason why we think that the Fed will hike this much is the credit risk component, and this is a bit nerdy, but we do look at the mortgage tranches situated or made out in the most speculative cities, in the most speculative markets, the commercial real estate. And we can see that we're already seeing a credit squeeze here that's sort of arguing for the Fed should take it a bit careful. Now, this type of credit argumentation is actually more forward speaking versus the Fed than, for example, labor market or inflation. We think that's pretty interesting. So there's a clear sign that the Fed will probably not be able, or they don't intend to hike as much as they have previously spoken about. But obviously they have to play the game, and they always do this. They always enjoy talking tough or talking dovish and not having to deliver as much as planned. Now, in terms of the equity market, we're still constructed despite this, because obviously if we're right in terms of the Fed and the inflation and everything, we have a ample of lift there going into the equity market. But on this slide, we have broken down and copied JP Morgan Quant's 100% equity market indicator. And it's 100% going back 30 years, looking at the following 6 months equity returns. And basically, when our signal is breaking the horizontal blue line, we get one of those signals, and we're probably going to break through that today. This is Monday as we speak, so that would be a great setup and a reason for us to relax and not be too stressed about the last couple of days move against us, which could also be having to do a little bit with the new legislation from European Union, where online companies, tech companies, have to take a lot larger responsibility of what content is driven on the platforms, i.e. are we doing marketing to minors, etc., etc. And they can be fined to up to 6% of the annual sales. So obviously this was a big, I think a little bit of a surprise when it came out end of last week, and it's going to be in effect in 2024, so quite quickly. That could also be a little bit of an effect that we have to take care of. Now, the biggest reason why we are bullish, or one of the biggest reasons, is the profit outlook. And what we like to do in the light blue line is that we like to look at what the corporates are telling us about the sales and profits, and compare that to what the analysts say. Because expectations on profits are all about the reality versus analysts. And by extracting the spread between what corporates are telling us versus what the analysts are forecasting, we can anticipate if the profit growth will be positive surprises or negative surprises. We were coming through a quarter now in Q4 which was the negative surprises. We could see that, we could front run that, and now we believe that we're going to be back into a positive surprise quarter. And this is, for us, is quite key. So far, with about a fifth of the companies been reporting, we think that we've been proven right on this. We haven't been paid off as well as we had hoped, but we're sticking to this gun because at the end of the day, the market tends to fall back on earnings revisions, etc., etc. And speaking about EPS, earnings revisions data, it's all positive. The revisions have been positive all throughout 2022. And this is the last EPS data from the market, and here's where we were back in October. So basically, we saw the same hump, we've seen the equity sell-off, and then obviously the EPS are talking a completely different picture on where the spot should be in terms of the equity market. So we hope and believe that this will actually be a buying opportunity, and that's what we moved in on the market on 9th of March, and we're sticking to that as long as profit outlooks are revised upwards. Now, what I started off by telling you is what we don't think is driving the market anymore in terms of inflation, US politics, geopolitics due to Ukraine, etc., etc. What is actually driving the market is this picture, which is all down about macro. Macro for us is not this kind of very slow-moving GDP data. When we talk about GDP, we talk about daily measured GDP data. And as such, we can look at surprises on every single day in all the bigger economies. And you can see that we have a huge run of positive data in the US macro. And now we obviously have negative data in Europe, obviously given the war. But that means that the macro environment is, whether we like it or not, dictating somewhere between 95 and 98% of the global equity move. This is just the S&P 500. And actually, the reading of 98, which was actually the highest we've seen for a number of years. That means if we are able to pinpoint where the macro is going on a daily basis, we know currently about 95% accuracy of where the equity market will turn. The trick here, of course, to understand where the macro is moving. But we think actually the market has a too low perspective on US growth, and we are a bit more optimistic on that. So that could be a potential trigger point for this week. And that sort of leads us to this recession argument that I know is going around the market. Yes, we see a probability for recession. We see it being 5% this year and 14% next year. And then it's going to move down to about 10% going all the way through 2023. So we don't see a high probability of a recession as we're speaking. And we measure this, as you can see here, we are predicting Federal Reserve's recession probability indicator, which is actually going a lot lower than our prediction did. But what I think is encouraging is that we can't see that skyrocketing recession probability. Now we can all be nervous and we can all discuss it, but we will not do any positions on the back of it until we can actually see it in data. Now this is just the Fed's credit spread recession indicator showing you a 5% recession probability for next year. And it's the fourth lowest reading since the 1970s. So for us, and this is why we think the JP Morgan quant model is pretty interesting, because we always try to pinpoint the troughs, because that's where actually we can make a lot more money than the peaks in the equity market, given how you all know the statistics in terms of missing out on the best 10 days, or being able to avoid the 10 worst days. It's a lot better to hit the 10 best days than to avoid the 10 worst days. So that gives us that we and a lot of other people in asset management, we have to have an underlying positive aura, because otherwise we're going to have a hard time with the index or competitors, given the fact that the market is trending upwards, basically. We do not forecast that the market will trend sideways or downwards. Hence, we're seeing trying to hit the troughs. And we did that on 9th of March. We don't think this will be a lower trough, but if it is, we'll see what we can do then in terms of increasing our equity share even more. Now, in terms of data coming out this week, we are in a positive environment in the world, in the US, as I mentioned. We have a 2.8% forecast for the GDP data, the consensus is at 1%. We do believe that we have both JP Morgan and Goldman Sachs indicators on the right-hand side here on this graph. I think we are in agreement with them, pretty much. And which is obviously a lot higher than the consensus, which would be good for the markets, of course. And then we have the Riksbank. We have Federal Reserve next week. We have 8 hikes priced from the Riksbank, and this is where the curve is lying right now in Sweden. This is where we were 3 months ago, 1 year ago, and this is the Riksbank's forecast. Now, given the fact that we have 86% likelihood of a hike this week, we are taking this opportunity saying, okay, we don't necessarily need to have a position on that. All we can say is in terms of a risk reward, we want to be short SEK. And our reason is that the Swedish economy cannot hold a too rapid rate increase. 8 hikes are pretty much too many, because we are already in a negative GDP environment. If you look at the monthly GDP indicator, it's negative, it's a fact. And we are there, and we also have the lowest real wage growth since the 1993. We think it's a bit risky to go ahead of ECB and front run hikes in Europe in that sense, which we think is a small probability, or let me put it this way, given the fact that 80%, the market's priced in 80% probability of it actually will happen, we think the risk reward is to be on the other side, basically. There are too many signs of stress in order not to do that trade. So we are greatly enjoying short SEK against the dollar. We have a good day today, which we're sort of cutting our equity losses in half, given the spot move. So obviously there are days which is greatly rewarded, and we think this week will be pretty interesting. Now I will stop there, but I will stop there because there's a lot more here. We could talk about the Swedish real estate market, capital flows, etc., etc. But I think let's focus on the Riksbank. We think the risk reward is for them not to hike, and we utilize that by dollar SEK. We actually don't have a position on the Swedish rate market for this, but that's where we stand, and we are a lot more positive than the market on US GDP. And we also see that the underlying earnings cycle will come back and lift the equity market and assist this sell-off that we see as quite temporary. And we see it's temporary given how the vol market is trading versus the spot market in the equity market, and that's what the JP Morgan model is depicting, that if anything, we could actually lining ourselves up for a quite nice little rebound here. So who knows, we might see a rebound Tuesday, turnaround Tuesday, which should almost become a classic these days, or a bit later on in the week. But given the underlying super cycle and the earnings growth, we don't think it's time to be too naive, or I shouldn't say too naive, but being negative for the time being. So with that, I stop in order to spare you some time, and I thank you so much for your attention, and I will be back in a week. Thank you so much.